Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial chaos out there. Today we are diving into an amendment to an 8K filing from Calisa Acquisition Corp. And let's just say this one is more about fixing a paperwork hiccup than a groundbreaking announcement. But sometimes those little fixes tell you a lot. And if you enjoy getting these clear up, straightforward breakdowns of company filings, make sure you are subscribed to the channel. We also have a really active Discord community where we discuss these things further, so make sure to check that out in the description below before we dive in. So what we have here is an amendment to a previous filing, an 8K filing, that is basically a report for significant events affecting a company. This amendment from Calisa Acquisition Corp is to fix something that was missed in the original report from October 2025. Think of it like finding a typo in an important document and then sending out a corrected version. The initial public offering or IPO for Calisa became effective around that time, and this amended report is mostly about adding in paperwork that was accidentally left out. The big news, if you can call it that, is that Calisa Acquisition Corp entered into several agreements in October 2025 tied to their IPO. These are the usual suspects you'd see with a company going public. We've got an underwriting agreement with Earlybird Capital Incorporated, which essentially means the investment bank is helping them sell their shares to the public. Then there is a business combination marketing agreement, also with Earlybird Capital Incorporated, which probably means EBC is helping them find a company to merge with or acquire later. These agreements are pretty standard for a special purpose acquisition company or SPAC like Calisa. SPACs are formed with the sole purpose of raising capital through an IPO to acquire an existing company. So, the money raised in the IPO is meant to fund that future acquisition. What is really interesting is how they structure their offerings. They're dealing with units each consisting of one ordinary share and one right. They also have ordinary shares with a very tiny par value per S hair, like 0.00075 US dollars. And then there are rights, each entitling the holder to a fraction of an ordinary share upon the completion of the company's initial business combination. This structure is common for SPACs, giving investors a package deal that could potentially offer upside as the company pursues its acquisition goal. The fact that they're listing ordinary shares with such a low par value is typical for companies going public through this route, and it just means that on paper, the share is worth very little. The real value is intended to come from Calisa's future business deal, and those rights are essentially options that give holders a stake in the eventual acquisition. The company is also registered in the Cayman Islands, which is a common jurisdiction for incorporation for companies listed on US exchanges. It is worth noting that Calisa Acquisition Corp is identifying itself as an emerging growth company. This means they can take advantage of certain regulatory accommodations, like being able to delay adopting new accounting standards. This is a common designation for newer public companies. The most important takeaway from this filing is that it is an amendment to correct an oversight. The company explicitly states that this amendment is only to fix the inclusion of a missing exhibit related to the agreements they entered into around their IPO. It is not updating any financial performance or business strategy details beyond what was assumed in the original filing. They are essentially saying, oops, we forgot to attach this document, here it is now. Now, let's talk about what this means in the bigger picture. For Calisa Acquisition Corp, this is a procedural step. It highlights the importance of meticulous record keeping and filing accuracy. While no new financial information is presented here, the original IPO, which this filing is tied to, sets the stage for the company's future. The success of Calisa will hinge entirely on the business combination they eventually execute. The structure of their securities with units, shares, and rights is designed to attract investors with the promise of future growth through an acquisition. However, it also carries inherent risks. The value of these instruments is highly dependent on the quality of the target company and the terms of the business combination. Looking at the broader market for SPACs, there has been a lot of scrutiny and a cooling off period after a boom a few years ago. Companies like Calisa are under pressure to find attractive merger targets and deliver value to shareholders. Delays or missteps in the filing process, even if minor like this one, can sometimes be perceived as a sign of operational inefficiency, although in this case it seems to be a straightforward administrative error. The fact that this is an amendment to an 8K means it is about significant events. While the content here is not earth-shattering, it is about ensuring regulatory compliance. Investors in SPACs are always looking for the actual business combination to occur because that is when the company begins its operational life beyond just being a shell for an IPO. Until then, the performance is largely dictated by market sentiment and the SPAC management's ability to find a deal. So, to wrap things up, What is the story here? Calisa Acquisition Corp filed an amendment to a previous report to include a missing exhibit related to their IPO agreements. This is basically a procedural fix, not a new disclosure of financial performance or strategy. The real story for Calisa will unfold as they move towards their business combination. The effectiveness of their IPO and the terms of the securities they issued are all building blocks for that future event. Now, looking at these filings more broadly, the strength of a company like Calisa lies entirely in its ability to identify and successfully merge with a promising business. The main risk is the inability to find a suitable target, or finding one that doesn't perform as expected post-merger. The opportunities lie in leveraging the capital raised to create a strong, growing enterprise. My take is that this particular filing is less about an assessment of their current business health, and more about the housekeeping required when going public. It doesn't give us new insights into financials, but reinforces the importance of due diligence for investors in SPACs. The conclusion here is wait and see what kind of business Calisa ultimately acquires. Alright, that is our breakdown on this amendment filing from Calisa Acquisition Corp. What is your take on this kind of procedural filing and what it can signal for a company? Drop your thoughts in the comments. If this explanation was helpful, please hit that like button. It really helps us out. And subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description below. Thanks for watching. See you next time.